Welcome to my 2019 housing predictions. I'm Kathy Fettke, co-CEO of Real Wealth Network. Real Wealth Network's been around since 2003, so I've been doing these predictions for a while. I actually got a little more serious about it after 2008. I was definitely trying to predict things back in 2005 when nothing really made sense in the lending world. I was a mortgage broker at the time, and I just couldn't understand how I was able to give a loan to just about anyone. So it didn't make sense to me, and I started my research then, and of course, sure enough, in 2008, everything fell apart. And since then, it has become a passion of mine to try to figure out what in the heck is going on. It's been harder and harder to do because there's been so much manipulation of the markets that it's anyone's guess where things will head, and that's what I think we're seeing a lot of, is a lot of guessing. So I just decided on this one I would grab a bunch of headlines and kind of show you where I think it might be headed based on headlines. So here's my disclaimer. This is just my opinion. Don't take it and run with it. Do your own due diligence. And of course, not every strategy works for everybody. So talk with your own advisors. Now, every year in January, I give my full predictions. I'll be speaking for about an hour and a half, and we only have about a half an hour today. So I'll only be giving kind of a sneak peek of the predictions. I'll be giving the full presentation on January 12th in San Mateo and on the 13th in Los Angeles. My husband Rich will also be speaking. He does his world famous focused investor seminar where he really brings in cutting edge data on how to be the most effective in today's very fast moving world. We kick off the year every year with those two presentations, and we're almost sold out. So make sure you register right away because there's limited seating. It's free, but there is limited seating. So make sure you register in advance, and that's how you do it right there. If you cannot make that event because you're not in California, both of these events are right by the airport, by the way, so it's kind of easy to fly in and fly out. We have lots of people come in from all over. But if you can't make it, we will be recording and you'll be able to see it in the future at some point. So I'm going to sum it all up in this one slide. And that is my boiled down housing forecast comes down to this. Real estate values are tied to jobs. Jobs are tied to the economy, and the economy is tied to the Federal Reserve and government policy. I mean, there's a lot more to it than that, but the Federal Reserve and government policy does some pretty massive manipulation that has torpedo-like effects on the economy. So that's the most important thing for us to pay attention to, which kind of, I guess, makes it easy for us in today's presentation to say, all right, well, if at the end of the day it really comes down to what the Federal Reserve does and what government policy is doing, then we might have a clue as to what is coming. So what we know, and I've been saying this in many presentations for several years now, that the Federal Reserve is tightening. It is a tightening measure. The Federal Reserve is very much involved in regulating the economy, at least it tries to. And it does that by raising or lowering interest rates and basically increasing or decreasing the money supply. So as we know, back in the last boom, we had really easy money, right? Easy money, easy lending, and that did not end well. So the Federal Reserve then tightened policy, and I'll kind of show some slides on that. In fact, I'll just show them now. What we know is that when everything collapsed, the Federal Reserve lowered interest rates to near zero levels. And then it worked. It basically jump-started the economy after it flatlined by making money almost free to borrow for the banks and for lots of people in real estate. So at those very, very flat levels, the policies worked and people borrowed money and housing was reinflated. So much so that you can see the Fed did a little teeny weeny raise at the end of 2015 to just see if the economy could handle it, that tightening. And it could. And so then it did a couple more. And then this past year, there were 4 rate hikes. And that was maybe more than the economy could handle. and I don't want to say more than, but we definitely saw an impact from 4 rate hikes this past year. And the headline news, of course, was that home sales dropped as a result of that. Existing home sales fell for the 6th straight month in September. And, there's been headline news about the housing market struggling. Now, I think struggling is really a stretch, but having been in the news business for so many years, I have my degree in broadcast media, and I worked at CNN and KTVU, Fox News, and the ABC satellite office in San Francisco. So I worked in newsrooms for many, many years in my 20s. And I know that you've got to have good headlines to get anybody to watch, especially today. Now, you fast forward so many years to today, there's so many places to get your news. It used to be that, you only could go to a few stations, and they were all competing for the best headline news to get your attention. And now they've got, thousands of outlets they have to compete with. So it's all about the headline. And the headlines have been exaggerated, as they always are, to get your attention. And that's been saying, oh my gosh, that the housing market is stalling. It's just slowing down, but it's in no major crisis at all. But definitely we've seen a slowdown and a shift, and things are turning. The Federal Reserve's tightening is working as intended. And that, again, is the most important thing for all of us to be paying attention to. Back in 2008, when we had a recession, the Federal Reserve did some pretty unprecedented things, like massive quantitative easing and their bond buying program to keep long-term mortgage rates low. And there was one intention for that. It was to reinflate the housing market, and it worked. It took 4 or 5 years, but it worked. And now they're saying, okay, we got to pull this back because it's working too well. Prices have gone up past their last peak. And that's basically what's happening. Now, the stock market has certainly been affected as well, but was it from that December rate hike, or was it something else? I mean, if you haven't been paying attention to the news because you've been enjoying your family and not watching this, then you might not know that the stock market took quite a nosedive at the end of the year, and most gains were lost. And people are hoping that will reverse itself, but it's certainly something to pay attention to. Is the stock market affected by these rate hikes, or is it more what's happening in Europe and so forth? Is it more of a global reaction, or is it because of the Fed rate hikes? But we won't be talking about stocks. I think it's just important. I just bring this slide up because so many times, like last year, we had a deal in Texas. I couldn't talk about it because a lot of our private placements are just that, they're private, so I can't talk about them publicly. But those who have joined our network and filled out the form, they knew about this. So last year, we had the opportunity to tie up hundreds of acres surrounding Texas A&M and San Antonio. It was potentially the best deal we've ever done. We had the ability to tie it up for $26 million, and we had a buyer at $43 million, and we were going to be able to flip that land in a matter of weeks, and investors were going to make a ton of money, and it was going to be my hero moment. But in the event that sale wouldn't happen, we wanted to make sure that the investors were safe. And so we decided, instead of buying the property, we would just get a lease option to buy and just buy the note, so that we had control of the property by buying the note, because the sellers were in distress. And so the worst that the investors would get was that 10% interest on just buying the note. But if we were then able to exercise the option to buy and then flip it on a same-day transaction, they would have doubled their money in a couple of weeks. So it was pretty fantastic. But the buyer had to back out at the last minute. It didn't work for the 1031 exchange because of some of the tax incentives couldn't be transferred. So anyway, our investors made 10%, and it was a little disappointing. I had my tail between my legs because it was just 10% instead of doubling their money in a couple of weeks. But you know what? 10% gain's pretty good when you look at some of the things at the end of the year that happened with the stock market. So don't be shy an 8 to 10% return is normally quite good. We've been so spoiled, over the last 10 years by double-digit gains. I think investors, this will be one of my predictions, we're going to start to see more normal returns, unless you really get that home run, and they still exist. But, a lot of people will poo-poo an 8% return or even a 6% return when, in fact, it may be that we're coming back to that kind of norm. All right, so let's look again at the Federal Reserve policy. And the reason I brought this slide up is I just want to kind of outline what happens when the Federal Reserve raises and lowers rates. So these lines here are recessions. And this line, the blue one, is when the Fed raises or lowers rates. Now, these are not mortgage rates. This is the Fed fund rate. It's what banks borrow money for. And I'm no expert in it, but I know just enough to be dangerous. So what we know is that usually the Federal Reserve will raise rates to slow down a boom, just like it's doing now. It's like, ooh, home prices are rising so quickly that people can't afford it anymore. Stock prices are way overvalued in some cases, maybe not now, but they were a month ago. So the Fed will raise rates, which tightens the money supply, slow things down, but they don't always get it right. In fact, on this you can see after the recession, they lowered rates, and then they started to raise rates because the economy was booming probably too much, and then bam, another recession, they lower rates, and then the economy starts booming, so they start raising rates, and when they raise rates, another recession, then they raise rates again, another recession. So you see it, they don't always get it right, and that's why it's so important that when the Federal Reserve is in this part of the game, which is raising rates, there is an impact, and we're feeling it, and we need to be prepared. It doesn't mean you pull out or stop investing. It just means that you position yourself properly to be aware. And there's so much positivity out there with the tax cuts and some of the policies that this administration is doing. You've got half the country that's just been very, very bullish and very excited about the future, and that's great. And it's also important to understand that the Federal Reserve runs on its own clock. Trump is not a big fan of these rate hikes and was not happy about the December rate hike, but he doesn't have control over the Fed. It's an independent organization. It's called the Federal Reserve, but it's not federal, and it also doesn't have reserves. So it's not a government agency. It's kind of a quasi-government agency, but it's pretty independent. So we do need to be aware of what the Fed is doing and what the government's doing. So my prediction, even though we've had these tax cuts that are supposed to fuel the economy and there's job growth, I'm still predicting, along with many other economists. I mean, basically I get my information because I interview so many great economists on the show. This isn't my research, it's their research, and then I just kind of put it all together and give my 2 cents. That, in 2018, it's looking like our GDP, our gross domestic product, is going to be around 3%, which was exactly President Trump's target. But most economists are expecting it to slow down in 2019, and a whole lot of economists are expecting a recession in 2020. Now, I'm not really predicting that recession in 2020, but I'm not predicting massive growth either. Just kind of a leveling out. That is if the Fed kind of slows down on its rate hikes, then I think we might be in a holding pattern. So, we'll see. But what would cause this GDP slowdown besides the rate hikes? In addition to the rate hikes is, just the uncertainty with the tariffs, which, is resulting in a decline in exports. And of course, this high national, corporate, and personal debt. Debt gets us in trouble every time, but we're addicted to it. We love debt. So, I love good debt, but nonetheless, it is debt. So with those issues. If you've got too much debt, well, you just can't borrow anymore. Then there's a limit to what you can borrow, and that can slow things down as well. So those are my predictions for the GDP. And at the same time, like I said, we have a government, we have a president who's all about creating jobs, but kind of at the wrong time, in my opinion, to be creating all these jobs, because we have such low unemployment already, and we're already at the top of this expansion. What that means is there's all these jobs, but there's not enough workers. So this was a report in October that the U.S. job openings topped 7 million. And available jobs in August outnumbered unemployed workers by 902,000 employees. So it's record job openings. Now, this is not necessarily good for the economy, because if there's that many job openings and not enough workers, well, then employers have to pay more and give more incentive, and that is not going to get eaten by the, those additional costs are not going to get eaten up by the stockholders. That's going to get passed on into the price of things, which creates more inflation. And unfortunately, what happens when there's more inflation is the Fed wants to raise rates. So the fact that there are job openings means that there could be more rate hikes in 2019, which would not be good for the economy. It may force the Fed to raise more than it wants to and could slow things down. So we really need to slow down all this job growth, or have more people, have more immigrants, or, just more babies, whatever, more people to fill these jobs, maybe train more people. But this is an issue because we have a really large population looking at retirement now with the baby boomers. So who's going to take all these jobs? So those are some of the things at stake. So in my prediction for 2019, I think unemployment will tick up slightly, which means there'll be some job losses. And where will those job losses be? That's what we have to pay attention to as real estate investors, is which jobs are here to stay and will grow, and which ones will be disappearing as the unemployment rate starts to level off. So 4 to 6% is considered healthy, and you can see we're below that. So, if it just comes back to the averages, we're going to see some job losses, most likely. So you just want to be in the right markets. Like, for example, we're building homes in Reno. We just got a new report showing that I think it was like they need 7,000 new homes every year, and they're not close to it. We're building 250 or something. Like, we're not really making a dent, and there's not a whole lot of land to build on there. It's hard to build on that mountainous terrain. So, and you don't have a full season either with the heavy winters. So you got a place like Reno where there's all this employment and not enough housing, and it's difficult to build, but you got all these tax incentives to be there, and it's 4 hours from the Silicon Valley, so many jobs moving there that that's an area where we don't think we'll see unemployment tick up, but you might see it in another area. And that's what you need to really be paying attention to. Where will those jobs, where will we see a leveling out? All right. Same with Salt Lake City. It just keeps growing. It's one of the top tech havens. You've got a lot of tech companies moving out into more affordable places, and Salt Lake City is one of them. Plus, you've got rapidly growing population there of young people and families. And so we're building just 20 minutes out of Salt Lake City on the way to Park City, and only about, 100 and something houses. It's not going to nearly make a dent, especially since they're on the more affordable range. So, we're not concerned about this housing slowdown with the properties that we've been bringing online for that reason, because they're in good areas that are growing so quickly, but housing's not growing quickly, fast enough to keep up with it. So how will all of this affect the housing market in general? Like I just kind of alluded to, there is no housing market. I'm using that term affectionately because everyone wants to know, what do all these policies mean to housing? And there just is no one housing market. It's just so diverse. And so we want to really be focusing our efforts on areas that are going to be growing when maybe the tides are turning towards stabilization and leveling off. And that's fine, but we want to be in the areas that aren't leveling off. We want to be in the growth markets. And where are those? So what we do know, if we're going to look at averages, and averages don't really do any good except just kind of give a snapshot. So on this, there's the average of the S&P Case-Shiller index, and you can see that, again, these gray lines are recessions. And you can see that for many years, prices were fairly level, and then they started to soar, even during this recession. Then of course, this is the easy lending time, easy money, and look what easy money did to housing. It just made it soar where it really should have been, if you followed this trajectory, really should have been right around here, right? So, of course, we saw this massive recession, and then home prices back on the rise. So when we talk about what is this new Fed policy, what's the impact going to be on home prices? Well, what we know is that during this time frame after the last recession, you had really low interest rates and really low home prices. So all the people that bought during this time frame, they've got equity, they've locked in low rates. No, they're not in a big hurry to sell their homes and get into a higher interest rate into a much higher priced home. So you see a lot of people, staying put and renovating or expanding their home instead of moving. And if there were job losses, I've said this at many seminars, let's say there was a lot of job losses in let's say Dallas. It's hard to imagine job losses in Dallas, but you've got all these people that have locked in these low payments, and if they were to lose their job and have to sell their house, well, they'd have to probably rent for more they pay on their mortgage. So it's my opinion that people will work a lot harder to keep their homes than they did when there was no equity in those homes, right? And their payments were, increasing. So it's a very different deal today, where payments are fixed and people have equity and they're locked into low payments. If they were to leave, they'd be paying a lot more for that same house. That was not the case back then. So, I don't see how the tightening measures and the government policy is really going to affect home prices, at least in the affordable range, in the median home price range. It's my opinion and the opinion of many economists that the housing market in general is on solid ground unless you're in the high end. Because I've been saying this for years too. I think I said it at last year's predictions. It's the high end that gets affected by these stock market gyrations. It's the high end homes that get affected by the changes to the tax law, because you can't write off as many. You can't write off the vacation home or the large mortgage payment the way you used to be able to. So these changes in government policy and fiscal policy are really affecting the high end, but definitely not affordable housing. So be careful if you're flipping properties in the high end. Just make sure that you have enough reserves set aside and you got the property for a steep enough discount that you can handle potentially lower prices and longer holding periods. All right, interest rates. Let's talk about interest rates. When I was talking about rates earlier, I was talking about the Fed fund rate. It is very, very different than the 30-year fixed rate mortgage. So what has been very interesting is that even though the Fed raised rates for the fourth time in December, we saw mortgage rates go down. And generally speaking, when the Fed raises rates, it's because the economy is booming. And so mortgage rates tend to go up as well, but not this time around. Mortgage rates went down. And if you listen to my recent podcast with Doug Duncan, the chief economist for Fannie Mae, if you listen to my latest Real Wealth show, he talks about, interest rates and, what the reason is that the long-term fixed rate mortgages went down in December when actually the Fed raised rates. So he says it's because of all the turmoil in Europe. That because of Brexit and because of Italy apparently wanting some special treatment and so forth, that a lot of European money is seeking the safety of U.S. bonds. And basically, when there are buyers for bonds, then there's also buyers for long-term mortgages. and those usually go hand in hand. So when there's fear out there and investors buy bonds, that tends to keep interest rates low as well, which again was why the Fed was buying bonds. When there was nobody buying bonds 10 years ago, the Fed was doing it. That was their bond purchasing program that kept interest rates low. And then they kind of stopped doing that because there seemed to be other buyers out there. And what we're seeing is some of these European buyers, which, maybe, and also the tariffs, there's just uncertainty out there. And so mortgage rates actually dipped. So I actually think we'll see home sales increase in a month or so because the rates are pretty good. And here's a closer snapshot of it. What has been interesting is that even though rates are so low, I mean, going back to the last slide, look at how low rates are. Even though they've increased, they're still so low compared to history. But the problem is they've been so low for 10 years that today's buyers don't know about all of these rates. They just know this slide, that rates, have gone up, and except for again last month, and that affects the payment by a couple $100 depending on the purchase of the property. And so today's buyer, who may be an older millennial, someone, usually the average home buying age is 31, but they're saying millennials are buying a little later, so maybe 32, 33. These people were 22, 21 during the housing crisis, and they, during this massive recession. So they have a very different view on life. They saw their parents lose a house. They got out of college and had a hard time getting jobs. There were no jobs. They were in the middle of the worst recession. They're scared of, having to go through something like that again. And they saw rates really, really low. So for them, this is a high rate environment and they don't like it. They're having sticker shock. And again, this is what Doug Duncan was saying on the podcast is, these are low rates and people should be jumping all over this. I remember when my dad was jumping for joy when he got under 10% on a mortgage. I think it was in the 90s. He got a 9% loan and he was so happy because it had been double digits for so long. But today, today's buyers they're in sticker shock. They don't like the increase and they're just waiting to see what's happening. And for many, they've just been simply priced out. They were maybe already on the edge of affordability and then higher interest rates just knocked them out because there's nothing affordable to buy and they might have just been on the edge. Then a slight increase really, threw them off. But that would be more in the higher end and in areas that were already lacking affordability, like the coasts, but not inland where there's still massive affordability. Then you're not seeing as much of a problem there. What we also know is the population has grown since the last recession by over 25 million people. And so we have a growing population and we have household formation because this huge generation of millennials is out, they're out of college and they're now the economy's booming, they're getting jobs and they're moving out and they're creating their own place. And now even you got the Gen Z, who's many of them are now graduating and forming households, maybe with lots of roommates, but they're getting out there. So we have population growth, household formation, rising interest rates, and consumer debt at all-time highs. Look at that. That's some pretty impressive debt. So, we love debt, and that's just consumer debt. I'm not even talking national debt or corporate debt, but just the consumer. So like I said, we got rising interest rates, so higher cost of a mortgage. And then you've got massive debt, and debt to income ratios are one of the main metrics that lenders look at. And a growing population, but not a lot of new affordable housing. It's just too hard to build it. So of course, then what you get is higher home prices, lack of affordability, and you get more renters, right? So when you are looking at the headline news and you're hearing the news and they're saying, oh my gosh, there's a slowdown in housing. It's just it's going to be another collapse and this and that. And these headlines that are freaking you out. You got to stop and say, wait, no matter what the situation, there's always a positive and a negative, right? So the positive for a landlord is more renters, right? The positive for someone trying to buy a home is not so positive, right? Like, well, last month with rates going down, that was a positive, but there's pros and cons to everything. What's the positive when the housing demand slows down and the ability to buy a home slows down? Well, that means if you are looking to buy, you're not going to have as much competition. So it's slightly better for buyers, not as good for sellers. So when you see this headline news, it's like, yeah, this could affect you if you're trying to sell. If you're trying to flip properties, or you're building homes, or you're trying to sell your portfolio, you may have to do a little more to get that property sold. You may have to make it look nicer. You might have to, really, it has to make sense. If you're trying to sell an investment property, the numbers need to work. But if you're a buyer, it's better. This is a better time for you. There's more inventory, more to choose from. Not much more, definitely not in the affordable range, but a little more. Now, in the higher end, there's going to be a lot more. So if you were looking for that luxury home, or potentially if some first-time home buyers now want to move up, this might be the time they can do it because interest rates are low and there's a little bit more inventory on the high end. So we might see some loosening up on the affordable housing side, where there'll be more move-up buyers in this coming year. But we're gonna need a whole lot of move-up buyers in order to loosen up the amount of inventory that's needed on the affordable end. Now, I just wanted to show this slide because this is the money supply, and I had kind of talked about the Federal Reserve earlier, but look, it was in the 1960s that Nixon took us off the gold standard. And what that used to mean is you had to have the money supply in line with the amount of gold we had, at least a percentage of it. But when that was removed, then it was kind of like the Fed could do whatever it wanted to do, not tied to gold. And you can see what that did, because politicians love to make promises. We love those promises as constituents. We want those things. So we're all for it, and we vote for the people who are going to give us the things we want. We forget that someone's got to pay for that. So the money supply has been increased, and it's the same trajectory that you see on stock market and on real estate prices, where values went up along with the money supply. So this is really unprecedented, having this much money floating around, and where did it all come from? Much of it was just created out of thin air from the banking system. So how will that play out? It is something to keep an eye on, again, because the Fed doesn't really know what to do. What we do know is on that slide with the interest rates, every time there was a recession, the Federal Reserve was able to lower interest rates to stimulate the economy. But look where we are today. So we don't have that kind of bandwidth, right? We're having a kind of a slowdown as interest rates are just barely where they would be normally at a time when the Federal Reserve is trying to stimulate. So there's not a lot of room left for the Fed to do its thing, and that's the concern. So some people say part of the reason the Federal Reserve is raising rates is so that if there is a recession, they'll have something they can do, which is lower rates, rather than lower them into negative territory. At least if they raise them, there'll be some kind of Federal Reserve policy to lower them again, but not by much, right? So again, this is something to pay attention to in the future. But what does this mean to you? Again, what this means, and I ran this by many of the economists I've had on the show, like what should we be aware of in the coming years, and is it still a good idea to own affordable housing? And the answer came back with a resounding yes, that when you're in this kind of environment where the high end is starting to slow down, but there's a desperate need for affordable housing, what we will most likely see is affordable housing prices increase. So even if there's a recession, it's very possible that affordable housing or anything below that would continue to grow in price while the higher end might be declining. All right, so here's just some examples of some of the markets. We've got 15 different markets that we've been liking over the past year or two. And this is just, again, to show you a slide of one of those markets. Cleveland is a market I bought in somewhere around 2014. So you can see, somewhere around, we kind of bought at the bottom. It has not really hit its peak yet. I mean, it dipped, but it's not as far above its past high. So there's still some room to grow in places like Cleveland. There's massive medical growth there and lots of more millennials moving into town. It's really gentrifying. But home prices haven't really gone back above their last high. Then you look at a market like this, and that might be just a little more concerning, right? When we were buying in Dallas, Rich and I were buying really aggressively right around this time, and it was really a boring time. People were like, man, nothing ever happens in Texas. Look at history. It's like prices never go up. But what it did have was great cash flow and lots of job growth, so we liked it. And then you can see, man, it just took off, but people are still buying. Is there more room for growth? And that is the big question. It's definitely getting tighter. Margins are thinner. It's a very solid, stable market, but you're just not going to get the cash flow, and you might not get the price appreciation. So does it make sense? Now, there's some outerlying areas where it might make sense, but these are the kinds of things we want to look at when moving forward, is how do we get into those markets that will continue to grow even during a recession because there's so much demand. Like I said, Reno. There might be a recession nationwide, but I don't know if it's going to hit Reno. And I certainly don't know if it's going to hit Reno housing because job growth is so diverse and it's in jobs of the future. And it's still so much more affordable than the closest tech town, which would be Silicon Valley. So, how do you find areas like that have this massive job growth and that will continue to grow even in a potential downturn or a stabilization? And here's Detroit. Detroit, as you can see, isn't back to its peak level. If you were to kind of follow this line, it's still a market that we like a lot because we see lots of growth, and we think this will be one of those areas that continues to grow even if there's a slowdown nationwide. So I'm going to go over a lot more of this at our live event and which cities that we think are great. Mostly we're going to be talking about opportunity zones, because the thing about opportunity zones is it falls right in line with what I said earlier, that government policy and Fed policy are what we need to pay attention to. And right now, the U.S. government is saying, look, if you invest in these areas, we're going to give you a massive tax break. And when you do that, they know full well that's where the money's going to go. That's where they want it to go. They don't want it more money into downtown areas that already have enough housing and already have enough growth. They want these other areas to grow, and that will help with the affordable housing crisis if we got more money going into where it's more affordable. So we think these opportunity zones are going to be the best deal yet, and definitely in this coming year and in the years ahead, because so much money will be going into developing and gentrifying these opportunity zone areas that you're almost guaranteed to see prices rise, even if the general economy slows. We just had a conference call or a go-to meeting yesterday with our team, with some of our teams nationwide, and they are so excited about the deals that they're finding in these opportunity zones. You don't even have to be using capital gain or investing in an opportunity zone fund to make money in opportunity zones. Because if you're just buying property in these areas, you're gonna, that's with the rising tide, right? So we're just super excited to unveil some of those areas at our January event and what we plan to do in these opportunity zones. But that, to me, is one of the best opportunities available in the coming year. And really the question is where, because, some opportunity zones are better than others. There's some that are really rough and they're really far out from where the gentrification is happening. It's going to take more than 10 years for those areas to come up. But other areas are just on the border and they're just booming, and they're next to universities and they're next to other infrastructure expansion. So very, very exciting opportunity in the opportunity zones. And I could tell you for 2019, that's where probably most of our focus will be. Okay, so now it's time for questions. Okay, someone asked if any thoughts that the 10 loan limit will be removed or expanded. I know that some really high-level people are working hard on that to convince the powers that be that we're going to need investors to be able to get more than 10 loans. So I think it will happen. I just don't know if it will happen this year. Bay Area median price dropped 3% in November. Seasonally adjusted supply is up while pending sales are down. With population growth nil, the Bay Area could become a much less dynamic real estate market, especially compared to metros experiencing rapid growth like Phoenix, Seattle, and Texas. I've been saying that for a while, to just be careful in the Bay Area. Prices, it's the most expensive place in the country, and that's concerning. Now, will it see any kind of major slowdown? I don't know. It's still a mecca for the tech industry. But what I would pay attention to is how many of those tech jobs are based on massive debt. And as interest rates increase, how will that affect these corporations that can barely pay their interest payments now? So, just make sure, I wouldn't personally have a big portfolio in the San Francisco Bay Area. But at the same time, if you bought a long time ago and you just like being near it, I don't know. I've never been a big fan. I feel like you could sell one property in the Bay Area and buy 10 or 20 or 30 elsewhere. You could take all that capital gain and invest it in an opportunity zone in an up and coming area. I mean, that's 100% what I would do if I owned property in the Bay Area. Unless I were living in it and plan to live there for my whole life, then I might stay. But otherwise, you might as well rent, take all your capital gain and invest it in an opportunity zone or somewhere else. You get that $500,000 tax-free if you've lived in the property for 2 years, 2 of the last 5, and you're married. So, who doesn't want $500,000 tax-free? So there's a whole lot of reasons to really pay attention to Bay Area and not buy with the belief that prices will continue to rise. Can Kathy address the possibility that the rate hikes are in response to an overheated stock market in many cities or real estate bubble? Whenever the recession comes, 19 or 20, the Fed then has the room to cut interest rates. Yeah, I did say that. So that's exactly why the Fed has been raising rates. Rates were at zero levels for so long, and in an effort to stimulate the economy, and it worked. And the economy is stimulated, but it needs to slow down now. It's beyond affordability. Beyond what makes sense. The Fed is doing what it needs to do to slow down and prevent more bubbles from forming. The question is, can they slow it down without popping any bubbles? That's tough for the Fed to do. Hasn't necessarily worked in the past. I'm concerned that our current administration is not on board with what the Fed is doing, and in fact it's like opposing forces. And this is what I said on the last national TV show I was on, is this 2018 will be, in my opinion, known as the year that there were opposing forces at the top. You have the Fed trying to slow down bubbles, but you have a president trying to stimulate the economy with tax cuts and then these, job creation and tariffs. These are all, this all creates inflation. And if there's inflation, then the Fed has to raise rates, which can then cause the crashing of a bubble, the popping of a bubble rather than kind of a soft landing. So they're not working in unison, and that's concerning. That President Trump was very upset that the Fed raised rates, but we don't want inflation either, right? And the housing market and the stock market are highly inflated. So hopefully those two very powerful forces can be unified, because it's just, we don't want to see inflation that'll create more rate hikes, which then could really cause a bubble to burst if there is one, rather than just maintain and stabilize. One job growth, here's another comment. One job growth area is Boise. HP has stopped hiring into the Bay Area. Instead, it's hiring into Boise and some eastern cities. Boise will become a mini tech hub. Yes, I lost a lot of money in Boise, though, with that philosophy. So just be careful there. Rich and I bought 3 properties back in 2006, and for the same reason, because of there was supposedly going to be a tech boom, and prices, there just weren't enough employers up there that when there was a recession, it ended up being like just a handful of employers, and we were stuck with 3 properties we couldn't rent, and rents had to go down, and we sold them at a loss. It was a bummer. So the only thing I don't like about Boise is its size. It's little, and therefore a little bit more affected by any changes to the economy. But at the same time, if you can get a good deal there that cash flows, then you should be okay. And always keep in mind the possibility that if there is a recession, you might have to lower rents, and will your property be able to handle that? If you can handle holding the property through a recession, you're going to be just fine, because over time, real estate does continue to grow in value simply based on inflation, but you have to be able to hold it through the tough times. Okay, another question. Is this why Bay Area market seems to be going down? San Francisco, Palo Alto, Cupertino saw a reduction of more than 10%. Yes, it was. I wish you'd listened to my predictions last year. It was one of the highest, most expensive markets in the country, and way overvalued. And it was concerning to have all your eggs in one basket in one area that's also an earthquake zone and now a fire zone. So you've got to be really careful about being too invested in one area. Having 1 or 2 properties there that, if it goes vacant, you're 100% vacant, whereas you could sell it and have 10 properties. If one's vacant, you won't even notice. So yes, those prices were too high. We're seeing a slowdown. It's definitely because of rates. It's also because of the tax cuts that didn't help the Bay Area at all, because it reduced the mortgage interest deduction and the second home deduction and the SALT deductions and all that. So there's just not as much of an incentive tax-wise. So yeah, that's absolutely rising interest rates, rising home prices, and it peaked. All right, I remember being thrilled to get 11% in 1985 on my first house, right? Yep, so today's interest rates are low, but today's buyers don't realize that. Am I coming to Tampa in February? Heck yes, we are. We are doing an event there in Tampa on February 9th and 10th. 9th will be all of our affiliates coming out on the same day. You can meet them all at once. And then on the 10th, we'll be touring Tampa property. We don't have the details on the website, but we hope to have it up soon, but save the date. We really look forward to meeting our East Coast members at that event. What is outlook on the Bay Area market? I don't own anything there, if that tells you. We have our apartment there, but that's a different deal. We bought it with the intention of re-entitling it from 200 units to 800, and we have those entitlements, and we're going to flip the land and sell it as is. We're not going to build it out. So there's a reason why. Yeah, I think we're going to see a slowdown, except in certain areas, like somebody mentioned, opportunity zones. There's opportunity zones in the San Francisco Bay Area. If you really insist on investing there, I would look into the opportunity zones in the Bay Area. I think those will do well. Okay. Someone said investing in Reno. We don't find a lot of cash flow in Reno, so all we're doing is building. We're building homes there, and we're going to build an apartment in an opportunity zone there. We'll be talking about that at our January event, so definitely come to that if you want to hear more about what's going on in Reno. How do I feel about national debt and how it will affect the real estate market in the future? The debt is a massive problem. Massive problem. There's no way to pay it off. I have no idea how it's going to play out. All I know is that we just keep making more of it, and somehow pretending like it's not there. But it's not good, and I don't know what we're going to do about it. How will it affect real estate in the future? Well, the way I see it is a lot of that national debt eventually is just going to get wiped out, and someone's not going to get paid. But it's paper, and real estate is a hard asset with value. So, if there's a change in currency or a fallout or a bankruptcy, I don't know in the future. I think it's going to be 10, 20 years in the future, but people are going to still need housing. So it's kind of like gold, where gold has this intrinsic value. So does a property, because people still need to live in it. So I think if you've got affordable housing, well located, that would be one of the best ways to protect yourself, in my opinion. But of course, I'm a advocate for housing, right? I believe in it. I believe it's one of the safer places to hide. But maybe it's not. Maybe some of your holdings need to be not in U.S. real estate, which is why we're building homes in Costa Rica, in one of the fastest growing cities there, in a place where there's no debt. So if you were looking to diversify, I would definitely consider some investments outside of the country. And if you're interested in finding out more about our Costa Rica project, you can go to Real Wealth Crowd, realwealthcrowd.com, or just reach out to your investment counselor at Real Wealth Network. If you're a member and you log in, you fill out the form, you'll have access to all the details on Costa Rica. But that is one of the reasons we did it, is for diversification, because we want to be in areas in countries that have low debt and are seeing growth. What effect will the SALT deduction limit from the 2017 tax law affect home sales? We've already seen it. I think we're going to really see it as the tax bill comes in April and people are aware. I think really then we're going to see it more. Existing apartment buildings are developing. Well, if you're in an opportunity zone and you're trying to buy an apartment in an opportunity zone, you need to do a real deep rehab. There's rules around it. So you would have to do a massive value add on an existing apartment in an opportunity zone, which is why we're looking at the development side instead. Because that's easier to do in an opportunity zone, and that's where we're focused. But, if you're not in an opportunity zone, there's certainly some value add apartments out there that are in kind of the tertiary markets. I would be aware of the main, like Dallas, where there's overinvestment there, in Seattle, where we're starting to see rents decrease because so much new products is coming online. Okay, Kathy, let's go back to Reno. Yes, so someone said, I've been following Reno and there's a slowdown. Of course there is. There's been a slowdown nationwide, but we're still ahead of schedule. We're selling homes still. That was part of the original presentation, is look, we know we're heading into a slowdown. We know there's a recession, but we got this land cheap enough and we have no debt on it. We raised enough money to buy it outright, and for every 5 properties we sell, that we use that money to build the next 5. So we knew that there would be a slowdown. We calculated it in our pro forma, and we're not worried at all. In fact, we're ahead of sales. Even though we're behind because of weather, we're still on track with sales because the properties have sold so quickly. But we totally calculated that there would be a slowdown, so there's no concern at all. We think it's going to pick up again in the spring. Are there still 1031 exchange opportunities out of California? Oh, yeah, absolutely. There's more inventory now because sales have slowed. So in some of these areas like Tampa and Cleveland and Atlanta, areas where there was no inventory 6 months ago, there is now. And I'm not talking about the kind of inventory we saw in 2009. I'm talking about the healthy kind, where now when you call one of the providers, they actually have something to sell you. So it's the good kind. They're finding great deals again. So it's very exciting. It's a very good time to buy in these markets that our affiliates are already in, and they're already buying in the opportunity zone areas. That's been our markets all along. So they're already ahead, they have a head start there. So it's absolutely a great time to sell your California property and exchange it into some of these other markets that do have inventory now. Again, not they don't have too much, but they have enough that there'll be like a few properties to select from instead of none. When the recession comes, do you think Dallas home prices will fall? I really don't think so. We're looking at this slide, but you have to understand that these home prices, this was before all the boom in Dallas. So you've got just massive job growth, and Dallas home prices were undervalued by 26% when we bought down here. So prices really should have been up here. So no, I'm not worried about prices falling. I just don't know that they're going to really increase a ton. So, it's a solid market. Thoughts on Pittsburgh? We love Pittsburgh still. I think it's a great place. One of the, hey, it was one of Amazon's top picks, as was Detroit, and a lot of the markets on our hot market list were on Amazon's top 10 list. So we love Pittsburgh. We think it's a great place to invest. Let's see. Fresno, I think Fresno has opportunity, but just pay attention to jobs there, because you can maybe get a good deal, but you have to be able to rent it. But yeah, I think Fresno might be one of the last remaining opportunities in California, along with parts of Sacramento. Chico was one of my top picks for a while, but it's 14,000 homes gone. So if you could figure out how to build homes up there, you'll be a winner. Opportunity zones, you can find out about them. Just Google opportunity zone map, and you'll get it on the government website there. Las Vegas, it had a pretty high appreciation last year. I would have probably bought in the last couple of years. I still think there's opportunity, especially in opportunity zones in Vegas. But you might start to see some slowdown in the price appreciation. And you have to understand that many of the workers in Vegas are very low paid. So I think there's a cap on rents. So just be careful. Don't pay too much, because you probably won't get, you might not get a high cap rate. Let's see. We just watched a 7-unit building sell for $2.3 million in San Leandro. Yeah. I bet the person who bought it thinks I don't know. I hope they do well. Salt Lake City, great market. It's expensive though, so you're going to need to go to the outskirts, but lots of good opportunity zones there. Like I said, we're building in the area because there's such a need for housing. So yeah, we like Salt Lake City, but you're not going to get as high cash flow. So the big money is made in building. Why do I think, someone wants my secrets? You know it, you stayed long enough. I'm going to give it to you. Concord BART station is good because it's still affordable out there. And I happen to know that there's some really big things coming in because a friend of mine is the developer. So go to the city council, find out what the planning commission's planned, and you will be amazed. Okay. Let's see. Yeah, some of the markets, pretty much all the markets on our Real Wealth Network website are markets we believe in, and we're already in opportunity zones in all those areas. So our affiliates know exactly where to buy. So if you buy through our network, they're going to take you to the right opportunity zone areas. They know it very well. Let's see. Bakersfield, yeah, there's probably potential there. Portland, prices are high. Just be careful. I think we're seeing a slowdown there. And not going to get cash flow, but you might find some development deals. St. Louis has some opportunity. We have a team there if you're interested. Cincinnati, we love Cincinnati, and we love our team there. Savannah, Georgia, I don't know enough about it. Sorry. Risks of building in the next recession, there's big risks. And I think a lot of people are going to get in trouble. We are aware of the risks, and we're structuring things with that in mind. Like I said, we bought the land in Reno all cash. We raised and syndicated all cash. And in our building, we sold off some lots, and we're using that money to build. So we're staying out of debt, and we expected the slowdown. So we put it in the pro forma, and we're not surprised by it. But there's a lot of people that didn't put that in their pro forma, and they don't have a lot of margin, and they're going to get hammered, especially the big builders, because they have barely a margin as it is. Thank you. Someone said thank you for the New Year kickoff, and I say thank you. Phoenix, I think, is there's some opportunity outside of Phoenix. It's one of the fastest growing places still. How do we sign up for our group? You just go to realwealthnetwork.com and there's a join button. You just join, and then you have to fill out an investor form that's required by the SEC so that we can unveil some of our deals, our private placements with you. San Antonio, I think it's a good market, but be careful. We were going to build homes there, like I said, on those lots we were going to buy, but the area we were buying in there was already too much housing. It was overbuilt, and the wages had not gone up, so we backed out. So just be careful in San Antonio. It's growing, but the wages are not growing as quickly. Albuquerque, yeah, especially with Netflix. We know Netflix is moving there. We love Albuquerque, and we just did an event on Albuquerque, and we have a great team that's providing rental properties, fully renovated and managed to our members. Chattanooga, don't know enough about it. Houston, Class B property, love it. And opportunity zones, love them both. Yep. Houston's in desperate need for housing, so we like Houston a lot. Chicago, we really love certain parts of Chicago. They're one of the teams we talked to yesterday. They're so excited about these certain opportunity zones that they're certain will be growing in value. So yeah, we're excited about that. Austin, we love Austin, but it's expensive and doesn't really cash flow. How can I take equity out of my Bay Area home and use it to invest? You can do a cash out refi or an equity line, usually. And if I don't have cash or investment to sell, the only way to take advantage of the opportunity fund is to partner with someone who does. You have to have a capital gain to get the tax-free treatment, but you can still invest in those areas or in an opportunity zone fund. You just don't get the tax treatment if you don't have a capital gain. Even if you syndicate, even if I syndicate a deal in an opportunity zone, but I don't put my own capital gain into the deal, I don't get the tax benefit either. So no, you only get the tax benefit if you have a gain. So you got to sell something that made money. Seattle is tough to cash flow, and the rents are declining because it was overbuilt. But we have friends in Seattle who are doing really well flipping. Yeah, the opportunity zone is a brand new thing. You need to learn about it. So go onto our website, realwealthnetwork.com, and click on the Learn tab, and you'll see archived webinars. Or you can just go to the search button and look opportunity zones. We had 3 different CPAs do webinars on opportunity zones, and I would listen to those. You really want to know about those. Oh, somebody asked, I was a paid member, but not anymore. Okay, so here's what we decided to do. We sent an email out, and we have discontinued that program, and we are offering our content now to our members. So as long as you're a member, you don't have to be a paid member, you'll be getting access. But we're still donating 10% to those charities. So there's kind of an SEO reason that we had to do that. We were having, there's an email that went out. So if you were a paid member, then be sure to look for that email or reach out to info@realwealthnetwork.com to understand that what's happened. Okay, we are out of questions and out of time. Thank you so much for joining me here. Have a wonderful rest of your day. And I hope to see you at our January 12th and 13th event, January 12th in San Mateo and January 13th in LA. And you can find out at realwealthnetwork.com. All right, take care, everyone. Bye-bye.